Well, hello and welcome back to Principles of Macroeconomics. I am still your host, Dr. B. We are in the 12th week of our fall 2022 semester here at UDC. It's pretty amazing that how quickly the time goes by. We're mid-November, and I wanted to quickly take a moment to say thank you to all of you for your hard work in this semester so far. You're all doing fantastic, and I truly appreciate all of your efforts. I do. It means a lot to me as a professor to have students that are really striving for a good education, and I sincerely appreciate all of your hard work to this point so far. So so let's talk about this concept called the open economy. The open economy is a country that uh, engages in international trade. Very basic, yes? An open economy simply means that we engage with other countries around the world, with other economies, right? You hear the word economy, we think about a national economic system. Since we're talking about macroeconomics, we look at things on a global scale and on a national scale. An open economy is where one country, such as the United States, does international trade with other countries. That's where in other words, we freely interact with other countries around the world. Uh, and it's defined really through international trade. That's an open economy. A closed economy is one that does not interact with any other economy. An example of a closed economy would be North Korea. The North Korean economy stays only in North Korea. So whatever they produce in North Korea stays and is consumed in North Korea. Uh, that is an example of a closed economy. In an open economy, we interact with other economies by selling and buying goods and services. Okay, through international trade, of course. We buy goods from other countries that produce those products well. For example, the United States imports Japanese automobiles because they are well manufactured. The United States, exports wheat and other produce to other countries because we're very good at farming, right? So this is an example of the exchange of goods and services around the world. We, as a nation, also invest in other markets through the sale and purchase of stocks and bonds. For example, the United States invests in bonds in South American countries. And the reason why the United States does this is to have an investment in other countries, whereas the other countries benefit by receiving cash in exchange for bonds, right? So the United States purchases the bond from the other country. The United States, in exchange, sends cash to that country in exchange for the bond. A bond, as you recall, is very similar to almost like a loan with some interest attached to it, right? And it allows for the investing company or country to have a stake in that other country, right? So that's the concept behind it. So exchange goods and services between countries and also buy and sell stock and bonds in other countries. That's a concept within an open economy. That's how economies interact with each other. We export goods and services that we make domestically and we sell them abroad, right? Example of that would be the United States produces wheat. The United States then exports that wheat to Japan. So we produced it domestically and we sold it abroad. That's the concept of an export. An import is where we are purchasing goods and services from other countries. For example, the United States imports computers made in Japan, and we sell them domestically. And as you recall, we have net exports. This is a part of the concept of gross domestic product, remember? Imports minus exports equals net exports. That's the definition of net exports. Imports minus exports is net exports. There are cases where we might have a trade surplus or a trade deficit. A surplus happens when the exports are greater than the imports. Sometimes a country is really good at making something, and every other country on the planet wants some of that. Okay? And when that happens, that one country that's really good at making something, they will typically have what's called a trade surplus. Really good, like for example, the United States is really good at growing wheat. Other countries need more wheat. So the United States will export more wheat than it will import. Therefore, the United States has a trade surplus for wheat. Okay? Because you can have trade surpluses or deficits for commodities, for products, or as a whole. In some cases, we might have a trade deficit. The deficit, of course, is when the imports are greater than the exports. In most cases, we have the trade deficit here in the United States because we rely on other countries to produce goods and services and then sell them within the United States in order to have lower prices. Ethan, please, you have a question?
Oh, my fault. I didn't mean to cut that.
No worries. It's okay. It's all good. The ideal situation is to have what we call a balanced trade. It's where the exports equal the imports. Balanced trade. Okay, as you know, there's a lot of factors involved here. When we're buying and selling goods and services across borders, there's a couple of things that influence or impact the buying and selling of goods and services across borders. For example, sometimes we have to pay tariffs. A tariff is a form of a tax, and that tariff might be paid on imports or exports. Changing in the consumer taste for domestic and foreign goods. Currently, in the United States in 2022, we've seen shifts in consumer demand for products. The shift went to more of domestic products than foreign products. And the reason for this shift is because of the supply chain issues that we've seen over the past few years. If a product can be made less expensive in the United States, in comparison to other countries, there's a good chance we'll buy that product domestically. Because of the idea, of course, here is we're going to pay less wherever it's made. For example, the United States has the ability to produce wheat at a very low price point. So we will consume that wheat domestically. Whereas if the wheat was produced in another country at a lower price point, we would import it from that country. Another thing that has an effect on an open market, exchange rates. Exchange rates, as you recall, is the rate for exchanging currencies. Currently, toward the end of 2022, we have a very unique situation because of the global markets. Whereas at $1 is almost the same as £1 British. Very unusual. Usually the British pound is much stronger than the dollar. In most cases, $1 will get you about 80 British cents, or what they call pence. But currently, it's almost 1 for 1. Very unusual. The same with the euro. The euro and the US dollar, very similar right now, almost 1 for 1. In the past, if I went to the exchange place to exchange my dollar for euros, €1 would usually get me about 75 cents. So exchange rates have a big impact on open economy. Imports, exports, net exports can also be influenced by things like changing in income. Changes in income, of course, will have changes on consumer behavior for goods and services. Cost of transportation from one country to another. As we see a rise in the price for diesel fuel in the United States and across the world, we expect that the cost of goods will increase because the goods need to go overseas. If I'm shipping products from China to the United States, the cost of shipping those goods increases as the cost of diesel fuel increases. That cost is typically passed along to the consumer in the form of inflation. You pay more for goods than you normally would because the price of transporting those goods has gone up. Government policies also has an impact on imports, exports, and net exports. Things like tariffs or quotas. This chart shows us imports and exports for the United States from about 1950 to almost present day. And we see that our imports have overtaken our exports significantly. We import more than we export here in the United States because the United States has shifted from what we call a producer economy to a consumer economy over the years. It's important to also understand when we talk about an open economy to understand the concepts of finances. As you know, it takes money to buy something. It takes money to invest in something. It takes money to build something, right? Money, money, money. Money makes the world go round, as they say. And there's some truth to that. We call this concept capital investments. The idea of capital investing is that we're using our resources, financial resources, to purchase assets. And with the purchase of assets, we can purchase assets in other countries. Call that foreign investment. There are two types of foreign investment. One is called foreign direct investment, and the other is called foreign portfolio investment. As an individual or as a business, I can directly invest into another country by putting a building in that country, by purchasing a piece of land in that country, by hiring employees in that country. Those are forms of foreign direct investment. It's where the money goes directly to another country for the purpose of investing through buying land, putting a building up, hiring employees, etc. We call that foreign direct investment. Foreign portfolio investment is where individuals or companies purchase shares of stock or bonds in other countries. For example, if I want to purchase a share of Alibaba stock, which is a Chinese company, I can purchase that stock, and that by me purchasing that stock, it is a form of foreign portfolio investment. Which, by the way, quick sidetrack. For those of you who have a 401k or some type of retirement fund, and you have the ability to make decisions on your investments in those funds, I always recommend having a small percentage international stocks. And the reason for that is because as world economies go up or down, your portfolio of those stocks also goes up or down. So it's a nice way to have a very well diversified portfolio, is to have a few foreign stocks in your portfolio. Definition for net capital outflow is concept of investing in foreign companies or countries. A couple of things that affect foreign investment. Interest rates paid on foreign assets. Absolutely. Yeah, if I want to put a building up in Bangladesh, I need to probably take out a loan through a Bangladesh bank. And what will affect that are the interest rates. Also, interest rates paid on domestic assets. If I take out a loan in Bangladesh to put a building up in Bangladesh, it might also be affected by interest rates domestically. Economic and political risks will have impacts on foreign investments. Absolutely. Investing in China can sometimes be very risky because of the political risk. Political risk is because China is a communist country. In most cases, as a foreigner, if you're investing in China into a business, the Chinese Communist Party, the government in China, receives part of the investment. Yeah. So that's political risk. And of course, other government policies will have an impact on foreign investment uh, based off of the ownership of domestic assets. What I mean by that is, or an example of that would be, if I have a company that does business around the world, including China, in China, my subsidiary of my company is also going to be partially owned by the Chinese government. That's a part of their policy. Understanding exports is a big part of foreign investment. And when we look at exports, we talk about net exports in that sense. A net, a net export is when there's an imbalance between a country's exports and imports. Very normal for this to happen. Imports minus exports equals net exports. Imports minus exports equals net exports. So the difference between imports and exports is net exports. With net exports, it will also indicate foreign investment through net capital. Net capital is the difference between amount of foreign assets bought by domestic residents and the amount of domestic assets bought by foreign residents. The foreign assets bought by domestic residents, that's when I, a United States citizen, purchases shares of stock in China. Domestic assets bought by foreigners is where the Chinese citizens buy shares of stock of U.S. companies. The difference between those two, we call that net capital outflow. When the net exports are greater than zero, we call that a surplus. Of course, it makes sense. Selling more goods and services to foreigners, that of course results in more export, right? From the sale of goods and services, we can receive foreign currency, buy foreign assets, and use capital to grow outside of the country. So, for example, if China exports products to the United States, the United States pays China for the goods in Chinese currency, okay, or in American currency. When we pay in American currency, they're receiving U.S. dollars. They can then buy assets in other countries using that cash flow or whatever. But they could, in other words, they're growing. Yep, that's the whole idea behind it. When there's a trade deficit, a net trade deficit, an export deficit, that means we're buying more goods and services from foreigners. The United States has a trade deficit, a net export deficit, because the United States purchases goods and services more from other countries than we make ourselves. Net purchases of the goods and services need to be financed. They be sold abroad, and of course, the capital is flowing into the country that is providing the goods and services. In an open economy, it's important to understand the finances of the open economy by understanding the concept of gross domestic product. So, just as we learned before in previous chapters, when we talked about investing, things like that, we talked about gross domestic product. And in that, we talked about savings and investments. So, when we look at the open economy, we can say Y is equivalent to consumer spending plus investment plus government spending plus net exports. The national savings formula is savings equals gross domestic product minus consumer spending minus government spending. The formula could also be rewritten as gross domestic product minus consumer spending minus government spending equals investments plus net exports. Or it could be rewritten as savings equals investments plus net exports. Just a couple ways to rewrite the formula. The net exports can also be looked at through the lens of domestic investment, where net exports equals the NCO, where savings equals domestic investment plus net capital outflow, NCO. When there's a trade surplus, your net exports are greater than zero, which means your gross domestic product is greater than your domestic spending, we think. This also means that your savings would be greater than your investing. This also means that your net capital outflow would be greater than zero. Makes perfect sense. With a trade deficit, your net exports are going to be less than zero. Gross domestic product is going to be less than your gross domestic spending. Savings will be less than your investing, and your net capital outflow will be less than zero. There's a deficit. Makes sense. Less than zero means it's going to be negative. Of course, best situation is to have what we call balanced trade. It's where your exports equal your imports. Exports will be zero when this happens. Your gross domestic product will be equal to your domestic spending, right? So income equals expenses, basically, right? It's the idea is to have zero. Savings will be equivalent to your investing, and net capital outflow will be zero. This slide kind of summarizes the three different possibilities when it comes to trade. This slide shows us the difference between national savings and domestic investment. You can see that over the past 20 years, we'll say, the domestic investment national savings has gotten much wider. Okay, an interesting dynamic here in the United States. Capital outflow has significantly gone below zero. So what this means is the United States usually continuously experiences a deficit when it comes to trade. So it's just a really interesting concept. International trade means there's going to be exchange rates, right? Because we're swapping one currency for another. At that rate, the exchange rate is where the rate at which a person can trade one currency for another, right? Very simply put, $1, I might be able to get 80 British cents. Okay, $1, I could probably get 90 euro cents. $1, I could get $1.10 Canadian. $1, I could get 20 pesos. Okay, so the idea here is that you're exchanging one currency for another. Or I could get 80 Japanese yen for $1. Actually, technically, today it's 100 yen for $1. There's an appreciation for currency, which means the value of the currency goes up. Or there can also be a depreciation for currency, where the value of the currency goes down. There's an increase in the value of the currency. It's measured by the foreign currency it can buy. For example, I used to be able to use $1 to get 80 Japanese yen. Now, now it's 90 Japanese yen for $1. Today, 2022, $1 will get you 100 Japanese yen. What this means is that the American dollar is appreciating in value, and the Japanese yen is depreciating in value. Depreciation is where the value of the currency gets weaker. Appreciation is the opposite. If the Japanese yen gets stronger, it appreciates in value, the exchange rates will change. Currently, 2022, $1 gets you 100 Japanese yen. If the yen appreciates in value, meaning it gets stronger, $1, I could get 90 Japanese yen, then 80, then 70, assuming that it keeps appreciating in value. The exchange rate is determined by the goods and services a person can trade from one country to another. The real exchange rate is calculated by taking the nominal exchange rate times the domestic price divided by the foreign price. We're talking about price, we're talking about the price for the product, service. Sometimes we use indexing for exchange rates. Don't worry, I'm not going to have you calculate exchange rates. That'd be silly. Nominal exchange rates between the US dollar and foreign currencies is represented by the exchange rate. The price is based off of the index for the US bracket, and the qualifying price is the price index for the foreign market. But don't worry too much about all that. It's the concept that's important, not necessarily the calculation. Exchange rates go up and down. It depends on the goods and services, and also depends on the value of the dollar. Exchange rates will go up in a sense when there are more expensive goods and services compared to foreign goods. And consumers will invest less in other countries. When we talk about things like the exchange rate, it's also important to consider purchasing power. Purchasing power, as we talked about before, is how far the dollar will go. How much stuff can I buy for that $1, right? That's purchasing power. It's based on the theory of exchange rates. We know that exchange rates go up and down. And it depends on how far that dollar is going to take us in those other countries. If the US dollar gets stronger, of course, I can buy more goods and services in other countries. If it gets weaker, it's a little bit more challenging. So that's the concept behind purchasing power. Oftentimes, uh, individuals will take advantage of the difference between the values between two different currencies. What I mean by that is I can invest in another country's currency and wait for that currency value to go up and then sell that currency or exchange it back, right? And what happens there is that I'm taking advantage of the differences between the value of the two currencies. You can do the same thing with goods and services. The price of a good or service goes down in one country or remains the same in others. Obviously, I'm going to go for the one that's a lower price. So we call that arbitrage. The other thing to understand is this concept of the purchasing power and parity. When there's a parity, we're talking about equality. All things being equal, the parity is the difference in price. Okay? Purchasing power, it's how far the value, it's how far the dollar will take you in terms of quantity it can buy. We talked about those things before. If the value of the purchasing power of the dollar never changes, then the real exchange rate will not change. But we know that that's not the case. It goes up and down. Nominal exchange rates change along with the currencies of countries, yeah, and it reflects price levels of those countries. So exchange rates, they're going to change with price levels. That's what we expect. That's what normally happens. If a central bank in one country increases their money supply, you already know what happens when that happens, right? The value of the currency goes down. More supply, lower the value. Yeah, that's what we experience through the concept of inflation that we talked about last week. So, inflation. We see this graph. This graph's important. The reason why this graph's important is because we see the relationship between the money supply and the exchange rate. When the money supply went up, inflation went up. That's what we expected. But look what happened to the exchange rate. The exchange rate went down because the country at the time was suffering from inflation. Now, this example is from the German inflation era from 1921 to 1925. But we can see this here in the United States today. It's not hyperinflation, but it's still inflation. As inflation goes up, the exchange rate goes down. That's what I'm trying to convey. The idea behind purchasing power is how far the dollar takes us. So, simply put, when there's many goods are not easily traded when the purchasing power is low. And of course, as you already know, a lot of goods can't not be simply substituted for one or the other. There is no perfect concept of exchange rates. Okay. The reality is rates go up and down every minute of every day. That's the concept of exchange rates. They go up and down every minute, every day. Usually not too sharply, but they go up and down all the time. So it's very difficult to have something that's perfect when it comes to exchange rates. And these exchange rates are typically also seen in purchase power uh, at home and abroad. Any comments, questions, or concerns so far? We're doing all right. Okay, I'm going to stop this part of the recording and we'll jump into the next one. Stand by.